What if I told you that the world's second largest economy is eating itself alive from the inside out, and the shockwaves are already hitting your wallet, your job, and the global market you depend on? This is not some doomsday prediction. This is happening right now. China is trapped in a deflationary death spiral that its own government cannot fix because the very system Xi Jinping built is the thing causing the damage. And the craziest part? Beijing knows it, and they still will not change course. Before we dive deep into this, if you find this kind of analysis valuable, do me a huge favor. Smash that like button, subscribe to the channel, and share this video with someone who needs to understand what is really going on in the world right now. Trust me, by the end of this video, you are going to see the global economy in a completely different light. Let us get into it. So here is where the story begins. There is a word that has taken over China right now. It is called Neizhuan, which translates to involution, and it has become the single most important buzzword in the Chinese economy. It describes a brutal race-to-the-bottom competition where everyone is cutting prices, slashing wages, and destroying profit margins just to survive. Not to thrive, not to grow, just to stay alive for one more quarter. This is happening across every major sector in China. Real estate, electric vehicles, solar panels, steel, chemicals, even food delivery platforms. The entire economy is caught in a vicious cycle of overproduction, overcapacity, and collapsing demand. And no one, not Xi Jinping, not the Communist Party, not the central bank, seems to have a real solution. Let me put some numbers on this so you can feel the scale of what we are dealing with. China's Producer Price Index, which measures factory gate prices, has been falling non-stop since October 2022. That is more than 3 straight years of deflation at the producer level. 38 consecutive months of prices declining between -2 and -3%. Meanwhile, industrial output keeps rising. So you have more goods being made, but at lower and lower prices. That is the textbook definition of a deflationary trap. And consumer prices are not doing much better. In January 2026, consumer inflation came in at just 0.2%, well below what economists expected. And here is what really gets me. China's broadest price measure has been falling for 3 consecutive years. That is the longest deflationary streak since China transitioned to a market economy back in the late 1970s. We are literally in uncharted territory here. Now let us talk about the root cause of all of this, because this is where it gets really interesting and really ugly. The Chinese system is structured in a way that almost guarantees involution. Here is how it works. The central government in Beijing sets GDP growth targets. These targets are essentially political mandates. Local government officials are evaluated and promoted based on whether they hit those numbers. So what do local officials do? They pour subsidies, tax incentives, cheap loans, and free land into whatever industries Beijing has designated as strategic priorities. Right now, that means artificial intelligence, electric vehicles, wind energy, and advanced manufacturing. But here is the problem. Every single province in China is doing the exact same thing. Xi Jinping himself actually called this out publicly in July 2025 at an urban city conference when he said, and I am paraphrasing here, whenever we invest in projects, it is always the same things: AI, computing power, new energy vehicles. Does that mean every province in the entire country has to develop these industries? Even Xi recognizes the absurdity of it, but the system he built makes it inevitable. So what happens when 31 provinces all subsidize the same industries at the same time? You get massive overcapacity. You get hundreds of companies producing the same products, all fighting for the same shrinking pool of domestic consumers. And because Chinese households are sitting on their savings, Terrified by the property crash and an uncertain job market, there's simply not enough demand to absorb all this production. The capacity utilization rate for Chinese manufacturing dropped to just 74% in 2025. That means a quarter of China's factory capacity is sitting idle. Now, let us talk about the elephant in the room, the real estate collapse. Because everything, and I mean everything, traces back to this. The property sector in China was not just another industry. It was the backbone of the entire economy. At its peak, real estate accounted for 20 to 30% of GDP, 40% of local government revenue, and up to 70% of household wealth. The total stock of China's housing market reached between $50 and $60 trillion, 3 to 4 times the country's entire GDP. That is insane when you think about it. Then Beijing pulled the plug. The 3 red line policies forced highly leveraged developers to deleverage, and the dominoes started falling. Evergrande collapsed with $300 billion in debt. Country Garden followed with more than 1 trillion yuan in liabilities. And just recently, Vanke, which was once considered one of the safest developers in the country, a company that had significant state backing, found itself unable to pay its bonds. Rating agencies have warned that Vanke faces a maturity wall of 11.4 billion yuan between December 2025 and May 2026 that it simply cannot handle. The human cost is devastating. An estimated 80 million homes remain unsold or vacant across China. Housing prices in some cities have fallen by as much as 30%. In Shenzhen and Wuhan, developers were listing properties at half the price of units sold in the same complex just 2 years earlier. And an estimated 85% of the price gains in real estate since the boom years have been completely wiped out. For hundreds of millions of Chinese families who had their entire life savings tied up in property, this is not just an economic crisis. It is the destruction of generational wealth on a scale that rivals America's 2008 crash, except in China, it is still accelerating. And the ripple effects are everywhere. Construction material prices in Chongqing dropped by almost 70%. Concrete prices fell by nearly 50%. Local government financing vehicles, banks, investment trusts, furniture makers, cement companies, glass manufacturers, they have all been dragged into this crisis. The property sector is like a black hole, pulling everything around it into collapse. Now here is where things get really dangerous for the rest of the world. Because China cannot sell enough goods at home, is trying to export its way out of the crisis. China's trade surplus passed $1 trillion in 2025. Its share of global exports has risen from about 13% in 2018 to 18% today, and is flooding global markets with cheap goods, everything from steel and solar panels to electric vehicles and chemicals. For Europe, this is an existential threat. The price gap between Chinese and European manufactured goods has widened by more than 30 percentage points since the post-COVID reopening. When you factor in exchange rate movements, it is more than 40 points. European manufacturers simply cannot compete. Industries across the continent, chemicals, plastics, steel, furniture, are seeing rising Chinese imports while their own production declines. The sectors being hit hardest account for 25% of Europe's manufacturing jobs. This is not some abstract trade dispute. This is about millions of real jobs being threatened across the European Union. And it is not just Europe. Countries in the global south are feeling the pressure too. India, Brazil, Argentina, Turkey, Indonesia, they have all been forced to implement tariffs, anti-dumping duties, and local content requirements to protect their own industries from the flood of cheap Chinese goods. The irony is that China's own anti-involution campaign is essentially trying to stop the very behavior that its economic system incentivizes. Let me take you inside the electric vehicle sector because it perfectly illustrates how this whole involution dynamic plays out. China's EV industry has been the poster child of Beijing's industrial policy. Hundreds of producers emerged across the country, backed by local government subsidies and cheap credit. But since 2018, 400 EV companies have ceased operations. Of the roughly 100 that remain, the market is dominated by a handful of giants, led by BYD. But even the survivors are bleeding. The average profit margin for the entire Chinese auto industry dropped to just 4.4% in 2025, the second lowest in history. And while BYD manages about 5% margins, many others are barely breaking even. SAIC and BHC are at 0%. Geely and Chery are at 1%. Dongfeng is actually losing money at -1%. An estimated 50 unprofitable EV makers are expected to cut back or fold entirely in 2026. And behind these razor-thin margins is a mountain of debt that should terrify anyone paying attention. BYD's total debt hits 61.2 billion yuan, with a debt ratio exceeding 70%. That is a 641% increase in debt from the start of 2025, while profits fell by nearly a third. The chairman of Great Wall Motors publicly warned that the Evergrande of the auto sector has already emerged. It just has not exploded yet. BYD pioneered a particularly aggressive practice called D-chain, where they delay payments to suppliers for up to 270 days by issuing interest-free IOUs. Suppliers who need money earlier actually have to pay interest to access their own earnings. Other EV makers copied this model. The total IOUs and accounts payable across the industry range from 5 billion yuan for smaller players to 250 billion yuan for BYD alone. This is a ticking time bomb. There is also the widespread practice of converting brand-new cars into zero-mileage second-hand vehicles to artificially boost sales numbers and qualify for state subsidies. Producers are literally gaming the system to survive, and regulators are only now starting to crack down on these practices. And do not even get me started on what this is doing to China's young people. Youth unemployment for those aged 16 to 24 hit 18.9% in August 2025, the highest since the government changed how it measures the data. Even after seasonal adjustments, it was still at 16.5% in December. An estimated 87% of Chinese people under 30 carry some form of debt. A viral phrase has been spreading across Chinese social media, "No next life," reflecting a generation that has lost faith in the promise that hard work leads to a better future. They are drowning in student debt, unable to find meaningful employment, watching their parents' property investments evaporate, and being told by the government to just work harder. The lying flat movement, the let-it-rot mentality, these are not just internet trends. They are symptoms of a society in deep economic distress. Household consumption accounts for only about 39% of China's GDP, far below most developed economies, and even below China's own peer group of middle-income countries. Chinese consumers are exhibiting what economists call luxury shame, pulling back on spending in a way similar to what Americans experienced during the 2008 financial crisis. So what is Beijing doing about all of this? Honestly, not nearly enough. The central government launched an anti-involution campaign. Xi Jinping has been making speeches about it. They revised the anti-unfair competition law. The 15th five-year plan, covering 2026 to 2030, includes language about comprehensively rectifying involutionary competition. But the fundamental contradiction has not been resolved. Here is the core dilemma. Beijing wants to hit GDP growth targets around 5%. To hit those targets, local governments must invest in industries. That investment creates more supply. But domestic demand is collapsing, so there are not enough buyers. Prices keep falling, profits keep shrinking, and the cycle repeats. And on the demand side, while Beijing talks about boosting consumption, it has not fundamentally addressed the structural issues. There's no major reform of social safety nets, no significant redistribution of wealth to households, no real effort to shift the economy from investment-led to consumption-led growth. The government issued 4.4 trillion yuan in bonds to buy unsold homes, but that is a band-aid on a broken leg. Meanwhile, the fiscal situation is deteriorating rapidly. Local government debt reached $18.9 trillion by late 2025. Most bonds issued by local governments in 2025 were for refinancing existing debt, not for new investment. Revenue as a share of GDP has dropped by nearly 5 percentage points since 2021. The two traditional levers of Chinese economic management, fiscal spending and bank credit, are both running out of room. And here is what should really keep global investors up at night. Eurasia Group listed China's deflation trap as one of the top risks for 2026, arguing that Beijing will not do anything meaningful to stop it. With the 21st Party Congress looming in 2027, Xi Jinping is going to prioritize political control and technological supremacy over the painful structural reforms that could actually break the deflationary cycle. Living standards will continue to deteriorate, the fallout will continue spreading abroad, and the world's second-largest economy will remain stuck in a trap of its own making. Think about what that means for the global economy. China accounts for roughly 1/3 of total global manufacturing. When 1/3 of the world's factory output is being sold at below market prices because the producers cannot afford to raise them, that is not just a China problem. That is a global deflationary force that drags down prices and destroys margins for manufacturers everywhere. The trade war with the United States made everything worse. After Liberation Day tariffs and escalating tensions, Chinese exports to the U.S. fell nearly 29%. But China simply rerouted its goods through Southeast Asia, Europe, and emerging markets. Products are being shipped through Vietnam and Malaysia, reboxed, and sent to the U.S. to dodge tariffs. Meanwhile, China weaponized its control over rare earth elements, restricting exports in a way that jeopardized Europe's auto, tech, and defense sectors. Any stability in the U.S.-China relationship is, as analysts put it, rooted not in cooperation, but in a shared recognition that each side can inflict devastating economic harm on the other. And China's problems are rippling far beyond the major economies. Countries in Africa and Latin America that depend on Chinese investment and trade for their own growth are seeing those flows slow down. When Chinese companies are drowning in debt at home, they have less capital to invest abroad. So where does this all lead? The honest answer is that no one knows for certain. But the trajectory is clear. China is facing a structural economic crisis that cannot be fixed with the tools Beijing is currently willing to use. The property market continues to deteriorate. Deflation remains entrenched. Overcapacity keeps growing. Youth unemployment is stuck at alarming levels. Consumer confidence is near pandemic lows. And the political system makes meaningful reform nearly impossible because every incentive pushes local officials to keep doing exactly what caused the problem in the first place. Goldman Sachs projects China's GDP growth will slow to 4.8% in 2026. The IMF is more pessimistic at 4.2%. Fitch expects just 4.1%. Some analysts argue that China's actual growth is far worse than the official numbers suggest when you strip away the accounting gimmicks. The world needs to understand that this is not a normal economic slowdown. This is a systemic failure of a growth model built on debt-fueled investment, property speculation, and export-driven manufacturing. That model worked spectacularly for 30 years, but it has reached its limits. And instead of reforming, Beijing is doubling down on the same playbook, pumping more subsidies into manufacturing and flooding the world with cheap goods to compensate for the collapse at home. If you are watching this from Europe, from the United States, from Brazil, from India, from anywhere on this planet, understand that China's economic involution is your problem too. When the world's factory is in crisis, the entire supply chain shakes. When a trillion-dollar trade surplus floods global markets with underpriced goods, your local industries feel the pain. When 300 million Chinese consumers stop spending, global brands lose their biggest growth market. This is the story of 2026. Not just China's collapse, but the global chaos it is triggering. And is only getting started. If this video opened your eyes, hit that like button, subscribe to this channel so you do not miss what comes next, and share this with someone who needs to hear it. We are living through one of the most consequential economic shifts in modern history, and the more people who understand what is really happening, the better prepared we all will be. I will see you in the next one.